Olga Yaroshevsky. This is NexChange Now Interview Series, and I'm here today with Adam Vaziri, who's the CEO of Blockpass. It's a RegTech platform providing digital identity and KYC solutions. Our dearest friend from Hong Kong. Hey, Adam, how are you?
Hi, Olga.
How's it going? How's it going in Hong Kong? How's it going with Blockpass? So you guys at Blockpass are having quite a fruitful year in terms of partnerships. Is it like Waves, Polymath, OAX Foundation, right? And you're providing compliance solutions for all of these companies, is that right?
Yeah, so first of all, Blockpass is a platform for identity verification. We provide the toolkit for any startup or established business to verify their users in a very fast and highly professional manner. It doesn't require intervening with Blockpass itself. They can just sign up on the website, create an account, add credentials that they want to collect from their users, and hey presto, they can go ahead. So it's very much, on the one hand, a scalable software as a service model, but on the other hand, we do have strategic partnerships. And those strategic partnerships are when you have, for example, a blockchain such as Waves that wants to introduce on their own blockchain an identity verification component, because blockchains themselves do not have identity in the sense of, yes, you do have a cryptocurrency address, but that is not necessarily linked to a real world identity. It said, Richard Brown, he said from R3, no one knows on Bitcoin if you're dealing with a fridge. So, it could be IoT behind an address, it could be a human behind an address, it could be a company, or it could be, anything. So what Blockpass does is it links the identity of the person to their cryptocurrency address. And that is provided as a service, strategic partnership with other blockchains. So those are the types of partnerships that we work on. You mentioned Waves, that's one of them. Polymath, it's more individuals who want to invest in security tokens. They have to go through KYC with the issuer of the security token. And in order to do that, imagine that you were to buy IBM stock and then you were to buy stock from another company. With a security token, because you have a direct connection to the issuer, you have to do KYC with each one of the issuers. Whereas with Blockpass, the user would only need to do it once and then connect to the different issuers of security tokens with their identity. So it removes the essentially duplicative process that arises when you have things like security tokens that creates a direct link between the asset itself and the user and the requirement for KYC. So it makes
let's focus on STOs a little bit, because that's the main topic of the Block O2O event that you're taking part in. Why do you think it's even important to stick to KYC rules when operating with STOs in 2019? Or with digital assets management, or with blockchains? Why is it important to make sure that there is an actual person behind that token or behind that account?
A security token is a cryptocurrency asset that is regulated. Now, it could come in many different forms. If the form of it is a share of a company, then shares of company are registered. So if I transfer a share from me to you, then the company needs to register your name on the share register. So you need to be identified with the issuer of that share. Just because it's in a digital form doesn't change that requirement. And that is the case in many countries in the world. There are only a few countries that accept a notion of what's known as a bearer share, where if I pass you a piece of paper, you become the de facto owner of that share. But for the most part, over 95% of all cases, the person who receives the share needs to be identified with the issuer. So what level of identification is required, issuers of shares are not regulated per se. They are not a regulated financial services provider. So they wouldn't be subject to the same AML rules, for example, as a platform that provides services such as a brokerage. But nonetheless, they still need to identify who is on their share register. And that's a corporate law requirement. So identification, when you have a token that crosses borders, obviously cannot be done in person. So it has to be a digital process for identification. And so Blockpass basically alleviates that burden by giving the user or the recipient of a security token a very easy way of getting verified with the issuer in order for them to receive that token and transfer it on, of course, to other people. There are, of course, other variations of security tokens, but for the most part, these are registered assets and requires the holder of those assets to be verified with the issuer. Now, that's not always the case, but for the most part it is.
Are there, by the way, so let's focus on details. Are there any differences between different various crypto and fintech related industries when it comes to KYC and compliance? Or is it just basic proofs of ID, proofs of address, proof of funds, etc.?
Yeah, I mean, anti-money laundering rules are, the legislation is, if you want, homogenous, but how it is applied in different industries varies. And that's because their anti-money laundering is based on the principle of taking a risk-based approach. So if in one industry you have a particular risk, then in that is where you need to target your effort as a regulated company. So for example, if in the prepaid card industry, prepaid cards are used, to fund terrorism for whatever reason, because the typology of that business, of that industry, attracts terrorists to use that form of that method of storing value, then that's a particular risk for that particular industry. And so they have to mitigate that risk by enhancing measures to counteract people using it who are terrorists. So in another area of industry, for example, in cryptocurrency, it is alleged that cryptocurrency, because it has a bearer quality, in other words, that you can transfer it freely across borders, that it may attract the laundering of funds. And so therefore, regulated businesses that are interacting with those cryptocurrencies need to spend a little bit more time identifying where those cryptocurrencies have come from. With the banking industry, because you have transactions that are happening between registered accounts, when a bank wants to check the source of funds of one of its customers, it can establish that quite easily because the account is in the name of that person, and funds that are entering into that account, they are somewhat traceable. So you can see, oh, this is a salary payment, or this is, dividends that I've received from my share account. In some respect, it's a lot easier to determine the source of funds of a particular customer. Whereas with cryptocurrency, because there is no registered cryptocurrency account, that there is no such thing, and that, well, you can, of course, register an account, and that would be having an account with an exchange or Coinbase where they're storing the cryptocurrency for you. But even there, you can't really determine whether the funds being entered into that account are actually from the persons that the customer is saying it's from. So they say it's from a salary payment, but it may not be the case. And so the result is that the regulated person now needs to look on the blockchain to determine the level of risk associated with the transactions that they're receiving. So what I'm trying to say is that every industry has a different risk profile. And so AML rules are homogeneous legislation and penalties, but the application of that legislation is on a risk-based approach and changes according to each industry. So whether it's in fintech or prepaid cards or cryptocurrency, the risk-based approach mandates a different approach.
Yeah, but still, I think, I don't know if I'm right with the numbers, but from like 70 to 90% of money laundered are actually laundered in cash, but not in crypto.
Yeah, that's correct. Of course, cash is a very, it is a bearer instrument. We talked a little bit about bearer instruments. Cash is the first and most pervasive bearer instrument in the world. If I take $1 and I hand that physical note to you, then you are the de facto owner of that dollar. And as we know, there is a lot of cash in circulation, especially when it comes to the US dollar. So all you need to do to move value from one side of the world to the other is get a truck and drive it with US dollars in it. And, that's, of course, it's the most prevalent form of money laundering due to how ubiquitous the US dollar is, how ubiquitous cash is, and how easy it is for it to be received. Not everyone is willing to accept Bitcoin, but most people in the world are willing to accept US dollars. So exactly. for a money launderer, US dollars are much more, a much better target for them.
Right. Is there even a unified KYC standard for, let's say, fintech, blockchain related and based projects? Because as far as I know, a KYC standard has been one of the challenges of the whole industry, the whole verification process.
As I mentioned previously, know your customer, in fact, derives from AML legislation, which is talking about the identification of customers and the verification of the information provided by the customer. And that stems from the legislation itself. And that legislation comes from a Paris body called the Financial Action Task Force. So they determine policy at a, if you want, supranational level, and then each country puts in place the legislation for that. And so this notion of identifying and verifying, so identifying through provision of information of the customer, and then verifying that information against independent, reliable sources, that derives directly from the policy and the legislation. So is there a KYC standard? Yes, there is. It's written down in black and white. But as it is not prescriptive, it is not saying how you should verify the information provided by a customer. It is just saying that you must verify it against independent and reliable sources. It's not saying how that should be done. And so each country may have a somewhat different interpretation of how that should be done. So in some countries, it may be fine to receive information from a person, which may be like their name and their date of birth, and then to verify that against an electoral roll, because an electoral roll would contain the name of the person, or to verify that even against a government database as being a reliable and independent source. So, the legislation is not trying to be prescriptive, because technology can change. The way that we can identify and verify people may change over time. And also it changes according to each country as well. And you find that there are industry trends that are becoming more and more acceptable. Like the most regulated industry probably is banking. And probably the most tightest of regulations when it comes to onboarding customers. And so in most countries, there is a requirement to actually meet with your customer in person. I mean, which sounds, in my mind, completely crazy, because people consume financial services across borders now. They don't, wouldn't go and meet with their banker. And in fact, they don't probably have a banker. So this notion of actually physically meeting a banker is not really in sync with modern life. But that said, the way that banks are modernizing the onboarding is to allow for a meeting to take place, but that is done over video. Mm-hmm. In a way, it's opening up, banking to people that are not able to go and meet with the banker in person, and also where you aren't reliant upon branches, and branches, is a very antiquated system of having bank branches. I mean, you look at banks today, for example, Monzo and some of the newer banks, they don't have any bank branches at all. So I mean, on the side of banking, that's one thing, but on the other side, there are non-banking businesses such as gaming, of course, crypto, any kind of like Forex, or any kind of online-based financial services, which is non-banking. For those services, it's a lot more flexible, the process of identification and verification. And so there hasn't been so much, this entrenched view about having to meet customers in person. So for those industries, there's a lot of, they're already very much accepting remote onboarding. So, for me, like security tokens, cryptocurrencies and all of that, there won't be this notion of any meetings in person. Everything will be done via technology and will continue to do so. And that's what Blockpass is built for. It's built for that new industry that requires a lot more technology in order to access and communicate and authenticate their customers. So we're not building technology for the old industry, we're building it for the new one, making sure that everything can be kept up to date and compliant. As what you'll see is that the trend towards increased regulation is going to happen. But in order to mitigate that trend, because a lot of businesses may need to shut down, the way of doing that is to provide low cost, high quality and fast verification. And that's Blockpass's model effectively.
Speaking of flexibility and new technology companies, so I had an interesting discussion with representatives of the state-regulated cryptocurrency exchange, and it was actually about the importance of KYC and AML procedures. But still, why do you think that 70% of current crypto exchanges are still negligent to KYC, to do the KYC? And does it even affect the market?
I mean, cryptocurrencies exchanges, when I started, and that's back in 2013 as a lawyer in crypto, there were no regulations. There was a FinCEN directive on how virtual currency exchanges would fall within the Banking Secrecy Act in the US. But apart from that, there was no real application of law to cryptocurrency businesses. And so in that absence of regulation, a lot of businesses emerged. And cryptocurrency exchanges for quite a long period of time had a lot of flexibility about how they could conduct their business. But now it's no longer the case, because 4 years later, FATF, so Financial Action Task Force, has put forward a directive which will come into place by next year, which will mandate that every cryptocurrency exchange, anyone who is in the business of trading cryptocurrency, that they would need to be registered for that purpose, licensed, and that they would need to apply anti-money laundering regulations to the conduct of their business. So if there are 10,000, 20,000, 30,000 cryptocurrency exchanges and businesses currently in the world, I'm sure there are more, all of those would fall within those that set of regulation and that policy. Because once FATF has come out with the directive, then every country underneath that puts it in place, and you're talking about hundreds of countries, over 150 countries that would put that in place. So the fact that today some cryptocurrency exchanges consider that they can still be flexible around the application of anti-money laundering regulations is just because those regulations have not bitten yet, and they will bite next year. And at that point, you know, this notion of flexibility will kind of dissipate, and everyone will accept that the new status quo for all cryptocurrency businesses is being regulated.